Hello, I'm Tag,
And this is Bob.
and you're listening to Bob and Tag Talk. Before we start the show, I'd like to point out that the topics discussed on Bob and Tag Talk are for informational purposes only. So please don't take this as investment advice. We urge you to do your own research before making any investment. Alright, so today we're going to continue the theme of season 3, being we're going to talk about a lot of international mutual funds. So just to recap, last time we talked about what are international mutual funds, how can you invest in them, what are fund of funds, and we talked about the advantages of investing in such funds and the disadvantages also. And finally, we talked about a very specific fund last time called PGIM Jennison Global Equity Opportunities Fund, and we talked about why, what sort of companies they have, what are their holdings, and so on and so forth. So this episode, we're going to talk about.
So we are going to look into something called the Mirae Asset Mutual Fund House. So they are not just a mutual fund house; they also have a lot of ETFs. So I think previous episodes, also previous seasons, what we have spoken about, we also spoke about what are the advantages of ETFs and what are the advantages of mutual funds.
Right.
So just to recap on that, the ETF is an exchange traded fund. It is almost trades like a stock, and you need to have a demat account to buy an ETF.
Right.
And a mutual fund house is just like you need to open a folio number and account with the mutual fund house, and you can immediately. So the mutual fund will invest on behalf of us.
Okay.
So they have the Mirae Asset is fund house which provides both ETFs and mutual funds.
Okay.
And what we are looking for is exposure to international stocks.
Right.
So why do we want to expose to international stocks is mainly because either we assume that our domestic market exposure is not sufficient. We want to have currency kind of hedging. Or we want to look into some different kind of stocks where there is a lot more growth compared to our domestic sector.
Okay.
So these are the different kind of situations where we want to go for international fund investing.
I suppose it will also be if you're like looking for a very niche area to like invest in. So that's when you'll go for like more.
And one of the common rules that we have always discussed before is that if you are investing like 100% of your fund, so you need to have some kind of diversification, and it's not that 100% completely you're going to invest in international mutual funds, 100% domestically. It's always better to explore at least 20% or 10% of your exposure, basically trying to invest in international stocks.
Right.
That is the kind of idea that we are going through.
Okay. So what is all about the Mirae Asset?
So Mirae Asset has one of their everyone who knows, are into investing. They know about the US stocks. And they know about the top 10 US stocks. Mainly they are Meta, Google, Amazon, and then Nvidia because for the graphics cards and chips and semiconductors.
Okay.
And then we also have some kind of something like Berkshire Hathaway,
Right.
and then banks, US banks.
Right.
These are all large stocks, and they're very stable. And we can look into investing on these kind of stocks in different ways.
Okay.
So one of the ways is mutual funds.
Okay.
If you're really comfortable with mutual funds and then you don't want to, trade on anything, and you just are looking for long-term investing, and you just want to invest monthly some amount and forget about it. So mutual fund is the preferred way of doing it. So Mirae Asset has something called NYSE FANG Plus ETF.
Okay. NYSE FANG Plus ETF.
So FANG is nothing but Facebook, Amazon, and then Netflix, and then Google, and then others.
Okay.
So these are the primary. It's generally just a terminology for popular technology stocks. And so this particular one is an ETF, which we're discussing, but the same thing is available as a mutual fund also. So same fund house will give you both the options. Now the significant difference, like we already discussed before, ETF will always come with lesser expense ratios, lesser charges. And mutual fund has a little bit of an extra charge compared to an ETF. The only option is why we kind of go to mutual fund is we want to avoid trading.
Right.
The habit of trading, we don't want to cultivate it. So that's why if you're already okay with investing in mutual funds, you can always stick with that.
Okay.
And discussing the top equity holdings as part of the portfolio of NYSE FANG Plus. Again, like we discussed, Meta is around 12%. So this is the highest as of March 2023.
Okay.
So this one of the main reasons why everyone is buying more of Meta is because in the past 6 to 12 months, because of a lot of security concerns and then a lot of concerns with their overinvestment in kind of virtual
Reality
stuff, and then metaverse and things like that. So their stock has gone down a lot.
Oh.
So now a lot of people are saying that the Facebook itself, with the ads itself, it has a lot of value.
Oh.
So now that they are cutting down on employees and cutting down on costs, so the kind of revenue that they're getting from actual Facebook and Facebook ads and Facebook businesses, and due to elections and other things coming and things like that, it'll be a little bit more valuable.
Oh, okay.
So a lot of fund houses and individual investors have been looking at Meta and seeing that could be a upside of 10 or 20% in the next 1 or 2 years. They think that is valuable. So a lot of fund houses have been increasing their holdings in Meta.
Okay, even with all of the other talk about metaverse and all
So
of
they
that.
are saying that now the company is obviously cutting down on their expenses, so they'll have more profits and more revenues. So that is the belief.
Okay.
And then Nvidia has about 11.7 of exposure, 11.7% of exposure, and Nvidia, as we know, it's a semiconductor company which develops almost phone processors to graphics cards for all gaming and stuff. And the chip makers are really the leading chip maker in the world.
Right.
And it's based out of most of the semiconductor companies are based out of Taiwan. And there is only 1 or 2 competitors that are based out of Netherlands. So it's kind of a monopoly play. So they have a real monopoly on chips, and then there is a lot of controversies on chips, like the countries like US as a country itself wants to develop more chips and so on. So they have a tie-up with Taiwan, and they're trying to develop their semiconductor industry. So Nvidia will have a large play. So if we want to go whatever AI and any other things that is technology we are planning the next 20, 20, 30 years, Nvidia will be a large player in that. That is the belief that most of the investors have.
Yeah, because like everything needs all of these like hardware parts, so yeah, it makes sense.
And don't have a lot of competitors. Only few competitors like Taiwan Semiconductor has one single one company that we know of, and then there are a lot of small companies in the US which is also competing like Qualcomm and so on. So they are actually established players, and their revenues are really, really good.
Oh, okay, okay.
So that is one. And then other option is again the third holding that they have is Tesla, which is again more than 11%. So again, everyone knows about Tesla. It's a pure play on the growth in the EVs, primarily in the shorter term. In the longer term, some real bullish investors believe that they're also into AI. They will be also into so many other solar and other technologies which would really boom in 20, 30 years of time. That is a pure play on that. And one of the recent incidents or recent news that we have heard is Tesla is cutting down the cost of Tesla. So car about 30 to 40% in the globe, in all our global markets. So as the car gets cheaper, there will probably be more sales, more revenues, and so on. And the competitors, there's only one established competitor so far, is like BYD in China. But a lot of companies like Ford, BMW, they're really not established themselves. They don't have that kind of a differentiating product that really competes with Tesla. So they have 1 or 2 cars which are completely electric, which are really good, but they don't have a large scale manufacturing and so on. Tesla has this concept of gigafactories where they can really build millions and millions of cars in a very, very faster time. So all these kind of established car manufacturers don't have the capacity to manufacture EVs in that scale.
Right.
So they only have mostly ICE, the internal combustion engines cars so far. So and EVs are picking up slowly. Even in our country, EVs are picking up more slowly. So at least in India, we have only Mahindra and Mahindra as one of the leaders, and Tata as one of the leaders. So Tesla again, it's a global play. So we're looking at Tesla in that kind of a perspective.
So yeah, Meta, Nvidia, Tesla, probably the top 3 holdings.
Top 3 holdings, and one more there's AMD. AMD is again a semiconductor chip play. So it will be one of the backbones of the future technology industries. Very similar to Nvidia, it's kind of play like that. So we don't have to go into more details into that. The other are established players like Apple, Amazon, Netflix, Microsoft, and Alphabet, which is Google. So all these ones, we have talked to
a lot about it.
We talked to death and a lot of yes, that is true. A lot of people know the products. Apple again, even now in the last 6 to 8 months, we have seen that even though a lot of companies are facing difficulties, Apple does not face a lot of difficulty. So Apple is still having a lot of cash in their holdings, and then the CEO is also more trusted CEO in kind of the US industries, and their products are still very good.
Right.
And then same with Amazon is facing a lot of difficulties recently, but again their AWS business has a lot of scope, and then a lot of technology business has a lot of scope. So that's again a play on that.
Mm-hmm.
And Netflix is also a lot of improved in the last 6 to 8
True,
months.
yeah.
So like they are starting up with the different kind of subscription models, and they're tweaking their pricing so that they get more revenue. And then there is not a lot of challenges for Netflix still yet. Disney is also struggling to challenge Netflix, even though they have the better content. And Paramount and other technology players are there, but not really a challenge to Netflix as of now.
Okay.
So again, these are stable. And Microsoft and Alphabet, now they're going to completely switch to AI now.
Okay.
Microsoft is leading with the ChatGPT contract. They have the collaboration that they have. So now Microsoft is going to introduce something called as AI in their docs, words, and other products.
Interesting.
So you can get suggestions, and then you can do a lot of automated tasks and things like that. So that is what they are banking on, and they already released it at least. So a lot of things, and then they also have a lot of unique tools, like they own GitHub. So they acquired GitHub around I think 2015 2017, between that time. And when they acquired it, GitHub is like the largest open source project wherever. So they have a lot of technologies, open source software that is on the GitHub as well. And Microsoft is introducing AI tools in GitHub as well. It's called Pilot AI. So even if you're new to GitHub or you're learning a new technology, the Pilot AI will help you to learn. That is one thing, pick things quickly, and do programming in such a way that it is a global standard. So it will point out the risks in your code or security vulnerabilities and all those things. So these are really, really good things for programmers in the future. So Microsoft has a really good hold on AI now. They're also concentrating more on Bing with AI. So we are not sure how exactly. Google also is again competing with them. So is Google's business will remain or not? So one of Google or Microsoft will win in that kind of a thing. There are no other nearby competitors that are as good.
Okay.
So that's a play on that.
Okay.
And there's one more company called Snowflake. Snowflake is a pure kind of data related company.
Okay.
So they do data analysis and a lot of different things with data, financial data and so on.
Okay.
So that's this particular ETF has a 9.2% holding on Snowflake as of March 2023.
Okay.
So these are all the overall holdings, and then and it's very concentrated. The risk is it is very, very concentrated, but it gives you a good exposure. So you don't have to invest a lot of money in it, but a little bit of money. If you don't want to invest directly, opening a demat account opening a brokerage account in US and things like that, you can opt for this ETF, or you can opt for this mutual fund. You can invest from any country. And we also have to talk about the disadvantages. Already one we spoke about is concentration. Like if there is a downturn in the US, or there's a downturn in technology stocks, all these stocks will get hit. So we should not put all our money in it. We should be very careful with it. And what we have to note about is the ETF has something called as a minimum investment amount. We have to be aware of it. And the expense ratio also we have to be aware of it.
Right.
The expense ratio is higher compared to lot of other indexed mutual funds.
Okay.
So index mutual funds usually are 0.2 to 0.5%. It's a little bit higher, but not that high, 0.7%. So that's okay compared to that you're investing internationally, and you'll get a lot of benefits out of it.
Right.
So that was the summary of all the Mirae Asset NYSE FANG ETF.
So yeah, we discussed a small summary about the asset, Mirae asset, and I thought we could also talk about all the global events that have been occurring so far. So what's been happening all over the world in the last 6 months, and what we can expect, and where we can put our money in for the next 1 year or whatever it is.
Yeah. So just to give an overview of what has been happening in the past 1 year since Jan 2022, or more than a year now. So one of the main things is that since the Jan 2022, all the central banks of the countries have been increasing their rates. So what does that mean is, like, for example, if you're buying a treasury kind of bond or a treasury certificate, so they usually, initially they used to give like 1%, 1.5% in the US.
Okay.
So even it was the same in the UK and Europe as well. The rates were very low. It is like less than 1 to 2% only. So now what has happened is, in one single year, or the treasury rates have become almost 4%.
Oh, okay.
So it's almost 3% increase in 1 year. So what does that mean? So when treasuries increase their rates, that means banks have to give more returns on the savings account generally.
Okay.
Or basically, if they don't give, that means bank deposits are not attractive.
Interesting. Okay.
So basically, treasury is the most safest form of investing.
Okay.
So treasury certificates will come at 3 months, 6 months, 1 year, 3 years, 5 years, 10 years. So you put your money and then you get for let's say for 1 year you get around 4%, and then for 2 years you may get around 4.5%, and then 5 years you may get around 4.5, or sometimes more. Depends on the country's central bank. So this is the rates that which they decide. Why do they raise rates? Because of inflation. Inflation is a scenario where now there's a lot of extra cash that is being around in the economy. A lot of people are buying a lot of services, buying a lot of consumer expenditure is high, and then buying a lot of products and so on, and so on. This kind of a side effect of all the things that happened after the pandemic.
Yeah, makes sense.
So, and they've been giving stimulus checks as well.
Right.
So everyone has been getting some money, whoever's been unemployed and so on,
Right.
and things like that. So all is a side effect. Inflation is really high. So what is the disadvantage of inflation is the money that you have in a bank account is eroding fast. So for example, if inflation is at 6%, 7%, that means you're losing 7% per year.
Right.
So how do you get better returns?
Right.
So you have to invest in something that is at least giving you more than inflation.
Right.
So, and that's why all the banks and everyone they try to increase the rate, so that what they will do is they are encouraging people to invest in treasuries, basically deposit their money with governments or government related banks and so on. So all the money will be sucked out, and banks will stop giving loans at low percentage and give high percentage. So people will borrow less, and they want to create some kind of a credit tightening.
Okay.
So people don't borrow unnecessarily.
Okay.
Only people who have the ability to pay the amount back at a higher interest rate, only they will borrow the money. So this is the kind of the credit tightening structure that all central banks are coordinating, and then they are increasing the interest rates. So there are a lot of side effects. So one of the main side effects of increasing interest rates is credit tightening. Like we said, what is credit tightening is any startups or any small business, if they want to take a loan, it will be very, very expensive.
Yeah. Okay.
And if there's a large company, if they already have cash, they have an advantage. So people who don't have a lot of cash in hand, they'll have a disadvantage. They need to borrow money to pay something or to do some kind of a business, and that's what the banks are trying to dissuade from. They don't want to encourage that.
Okay, makes sense. Then I also wanted to talk about if there is going to be a recession very soon, because I hear a lot of talk like among colleagues or among friends, wherever it is, I hear that a recession is coming, you need to be careful and all of that. So
naturally, when the credit tightening is happening, a lot of small and medium businesses are not trying to borrow money, so they will not hire more people. They will try to cut down on the employees that they already have. So for example, they will only concentrate on core businesses. They have started some new kind of services, they're trying to kind of do some kind of a new R&D kind of a thing, they will try to avoid that.
Okay.
So this has already been happening in the largest technology companies like Amazon, Meta, that is Facebook, and then Google, and then even Microsoft, and then Accenture, even service companies, Accenture and TCS in India, and then a lot of other service companies, they've been laying off people.
True.
So what are the kinds of people they are laying off? That's the first thing. The US companies have been hiring a lot more people with skills based mostly related to AI and then related to the metaverse.
Okay.
So those kind of jobs they have cut down on. They have been laying off people. So the laying off means why they are trying to do is so they will stop spending on unnecessary things. They will concentrate on the core business. Like for example, if you take Facebook, they'll concentrate on Facebook as a product, Facebook business, and then advertisements, revenue from advertisements, and any other related things which is core to their business.
Got it. So it's like they're trying to focus because they know that recession is coming. They try to not focus on new things because they just want to do what they are already know works.
Good at.
Exactly.
What are they efficient at?
Exactly. No trying new things.
So this will save their money. and this will cut down unnecessary spending. So all the companies will start doing it. And then this is one of the things in the tech industry, at least this is what they are saying could be like recessionary. But there are other industries like industrials and then like shipping industries and so on. Due to the pandemic, they were already affected a lot. There are a lot of backlogs in shipping and transport and so on. There are a lot of over ordering and things like that in those kind of businesses. So that is also having an effect. Inflation is having an effect on that. And the other industry that seems to be affected is banks.
Okay.
So there are a lot of small banks in US, not actually small banks, they're like more medium-sized banks. There was one specific bank called Silicon Valley Bank. So this is totally based out of California. This particular bank is catering to a lot of venture capital investors and a lot of technology, smaller technology companies and so on. And also like, for example, cryptocurrency based companies and so on. So they are kind of giving loans for these kind of companies, these kind of venture capitalist investors and so on. So not generally loans also, sometimes they're taking deposits from them. So these are very unique and niche kind of investors. So this particular bank has kind of a risk in it called concentration risk on a type of depositors.
Okay.
So when the US Federal Bank started increasing the treasury rates, so that means these banks also have gone to a lot of difficulties. So for example, let's say you are a venture capitalist investor, you are basically you have like $500 million. You're planning to invest some time in the next 2-3 years in some kind of ventures. But now since there is a lot of difficulties, a lot of companies are facing difficulties, so you're not planning to invest in the next 1 year. So you have to wait for 1 year and then start investing.
Okay.
So you already deposited $500 million with Silicon Valley Bank.
Okay.
Now what happens, what did Silicon Valley Bank do? They give loans to crypto companies and other investors. So now those kind of companies are also cutting down on employees. So they will not need a lot of money. So then what did Silicon Valley Bank do? So they invested in treasuries. Treasuries, they invested with the US government. So they got bonds at around 2% or 2.5% or even less than that. But the duration was 10 years.
Okay.
So now what happens? So they deposit money with the US bank. 10 years, after 10 years, they'll get back their money. Or you can sell that particular treasuries as well. But you will be selling at a loss because now 1 year and 2 years at 4%. So no one will want 10-year bonds at particular date. They want rather something 1 year a short term which gives 4%. So they are they were actually looking at a loss of about 2.5% on their bonds. Nobody was willing to buy their bonds.
Okay.
This was something called as a duration risk in the banking sector. So this is one of the reasons where the banks had a lot of difficulty, and once people got to know that these banks have kind of mismanaged or did not understand the duration risk, so a lot of depositors started withdrawing their money.
Okay.
So when you say depositors, they are mostly like people who have opened an account with the bank. They just deposited the money. It's like not necessarily like term-based deposits. They're just checking accounts or saving accounts. So when they start withdrawing the money, and the withdrawal rate was like, because of internet, because of the technology we have, you can withdraw immediately using a mobile phone. So all the investors started withdrawing money, and the bank did not have sufficient cash in hand. So it caused a crisis, and what eventually happened was Silicon Valley Bank had to be closed down.
Okay.
So there is a insurance program for banks called FDIC, Federal Insurance. Basically what they do is they insure anything like around $250,000 per account. But a lot of investors had more than, they're all venture capitalists, they have a lot of money, they have parked their money in that particular bank. They started withdrawing a lot, and then this caused a crash in their stock first, and then they were not even able to pay the depositors back. Eventually, FDIC and the US government had to step in and say that whoever has an account with this particular bank, we'll give back all their money. We will guarantee them, even if the bank does not have it, we will take over the bank and we'll give back the money.
Okay.
So they're avoiding a crisis in that way.
Okay.
But all the people who have shares in this particular bank, all the bondholders of this particular bank, even Silicon Valley Bank can issue bonds.
Right.
People can buy their bonds. All this have made losses now. The bank is almost closed down. So it's basically the US government or the FDIC have taken control of it. And there is also another bank called First Republic. They also had this kind of problem. And then a lot of other banks like that. So now there's kind of a banking crisis. So now when there is a banking crisis, that means the first effect is always on small and medium businesses. So people are expecting that why? Because small and medium business have issues because people will withdraw their money and they will deposit into larger banks which don't have these kind of problems.
Yeah.
Like larger banks in US like JP Morgan, Wells Fargo, Goldman Sachs, and then Morgan Stanley and all these kind of banks, they will deposit their money with them so they don't have any problems like this. Their money is safe. So at the end of the day, savings account should be safe. That is the expectation.
Yeah.
But these kind of banks have kind of this kind of duration risk and other kind of risk or real estate risk and things like that. So they are all facing a lot of problems. And slowly, so the assumption is that the next 6 to 12 months, there's a lot of consolidation in the small banks. So small banks may start to merge, or some banks will start to acquire the small banks, and then so on. So this is going to happen. The consequence of this has been unpredictable in some ways that no one wants to invest in banks as of now. If they want to invest only in the top banks. So now a lot of people, the stocks have been going down for smaller banks. So any indexes, if you see, there's any small banking indexes or something like that, they have been hit badly. This is the risk of concentration. And then the other consequences now, it was not really predictable, but some people have said that tech companies are much more stable than these kind of banking companies. Why they say that? Because most of the tech companies, if you see, like let's say take the example of Apple. Apple has almost like billions and billions of dollars in cash. They invest only money market instruments. They generally don't have their savings accounts and all. They don't invest in those. Large companies invest in their cash in money market instruments, like basically like 1 week kind of deposits or 1 month deposit, 3 month deposits, and so on. So it's very safe and very stable. So these companies have a lot of cash. Now as the interest rate is increasing 4%, so they will get 4% just because they have cash. Now all the companies who have cash, they'll start getting this 4% annually. And even if they don't make money from their business, because they have so many cash, they start making more money. So that is why people are buying more and more technology stocks because they are already have so much cash in hand. So now technology stocks are kind of ripping. When I say ripping, it means that the returns are increasing. The stock price is increasing in the last 3 months. In the next 6 to 12 months also, it is expected that there may be more kind of stock increases in these technology stocks, and people are going back again to Meta, Google, Facebook, and so on. Even though there are layoffs and other challenges are there, but what people are saying is that when these technology companies make layoffs, that means they are cutting down on expenses. That means their profit will again increase. So that is why people are buying these kind of stocks. This is a good time to see whether globally, if you want to invest in technology, you can start slowly. It would be better if we have been doing it in the past 1 year, but even now it is not late. So you can start investing slowly in these kind of international stocks. That is why this kind of Mirae asset kind of FANG plus technologies is kind of an advantage.
All right. Okay. So yeah, that's a little bit about Mirae asset and what's been going on in the world and what is expected maybe in the next 6 months to 1 year. And yeah, I think that's a good spot to end it there today. Hey, thanks for listening to Bob and Tag Talk. Please consider following us on our Instagram and Facebook pages. We put out weekly summaries of the topics discussed on the podcast. And if you found this episode informative, please like, share, and subscribe.